And so when you gave us the Tesla unlevered free cash flow, adjusted EBIT minus CapEx minus capital leases, you're essentially trying to take that into account as well? Or can you show us what this number is? Because I usually off the bat, I'm like, EBITDA, I hate that, because like we should be taking into account DNA, because like we spent the CapEx to get this EBIT. So let's have the, we
Yeah,
should be counting
exactly.
the
So
DA, like, so I hate EBITDA usually, but I'm like, I know there's a lot behind this number and the way you think about it. So
yeah, so this unlevered free cash flow is another way to think about the growth of Tesla. And the reason why I use adjusted EBITDA in the starting point is because I still think that that is analytically the superior number for understanding Tesla's operating profit, because of three factors. One is Elon's bonus, right? So, with that bonus that was passed in 2018, I think that because of that above average stock-based compensation expense, if you are overly focused on GAAP net income, then you're going to consistently underappreciate Tesla's true underlying operating profitability.
but there's a friction to that underlying profitability, which is the cost for that incredible CEO, which is Elon, which is amortized in that stock comp, which is why it would be a justified expense, in my opinion. Would be like, yeah, like, okay, it's not the core business, but it kind of is, because the core business wouldn't have crushed it. We didn't have Elon, and we had to give him the stock package. So yeah, we should kind of,
That's
right?
true. That is true, and that's a valid point, and that's why it's included as a part of GAAP. But what it does is that it distorts what Tesla is fundamentally doing. So yeah, I agree that ultimately you have to have positive and growing GAAP net income in the long run. But for analytical purposes, right? If you are just focused on GAAP net income, then you'll miss what's actually happening under that layer of a short-term above average expense, right?
Yep. Because there's a lot
So
of
just for
fascinating
analytical purposes.
like things to unpack there, of almost like Elon should have a key man risk, because now we're like literally like mathematically showing his value almost to the way it's like Tesla's like, okay, they're like industry average, but they're actually super profitable, but we're baking in like this extra CEO stock comp for a genius CEO. And that's really what's happening with the cut. It's like, I
Yeah,
love nerding
exactly.
out on this, by the way, because this is
Yeah,
so fascinating. Like, Tesla's so unique in many ways. That's why I think
yeah,
almost every company is so unique. That's kind of my theory, is like comps or BS. Like every company, when you get down to it, is so unique. Especially Tesla. Like it's just, the CEO stock comp, the tie into all that. Anyway, I didn't want to
yeah.
get us too sidetracked there about the free cash
And
flow
just a
number.
side point to that too is that if you're again, like I think, see, one of the investors that I follow very closely is Bill Miller, who heads up Miller Value Partners. It's a hedge fund slash long-term investment management. He's kind of like another Ron Barron, so he's a phenomenal investor, and he actually understood Amazon very early on. And he basically has said in multiple interviews that I just don't place too much emphasis on GAAP earnings. Because if you do so, you're going to miss other things that are happening under the scenes or behind the scenes on that. So if you look at a chart of Amazon, it's had exponential, growth in the stock price. But if you look at that relative to their GAAP earnings, it's been like, it's constantly confused people into thinking that the stock is dramatically overvalued.
Dude, you got me
But
so
if you
hyped
look at,
because, yeah, keep going.
yeah, but if you look at EBITDA, for example, on Amazon, that tells you a different picture. So, and by the way, even as recently as 2015, which is not that long ago, it's not as if Amazon was a brand new company in 2015, but 20 years into their existence in 2015, they reported a GAAP loss on an annualized basis too, not just for a quarter, but for
Wow.
a full year. So if you're looking at GAAP, you're gonna miss too many things that are happening. So I think it's sometimes important to look at other factors that are slightly above the GAAP net income line, such as EBITDA, such as operating cash flow, even free
Yeah.
cash flow.
Operating cash flow. That is the first line that is in every Amazon press release. And if you look at the operating cash flow and kind of adjust for Whole Foods and stuff like that, that is almost perfectly predicted. The stock price is like gross profit and, operating cash flow multiples. And you can see just like a formula, the stock is following the increases in those metrics, which is so fascinating. And I love, so that's why I'm like, I did the whole Elon Musk, playing devil's advocate with you for GAAP, but I hate GAAP. You know what I mean? Like I'm also the guy who's like, look at Amazon, like like the GAAP isn't doing justice to have the true core intrinsic earnings power of this asset, which is the same for Tesla. And with Tesla is so fascinating is Amazon, okay, but I love the comparison in the early days of like, well, Amazon reached free cash flow profitability faster than Tesla or sooner than Tesla, or Tesla's free cash flow is worse. And I'm like, that's because what they're doing is 10 times harder than putting books in a warehouse that you don't have to do anything with. They actually have robots in the warehouse that are building things instead of just piling up books there. Of course, the cyclical cash flow profile is like a much bigger dip at the beginning for each factory and each thing, but it's going to be much more, and I'd say the moat's stronger. It's going to take long to replicate. Like this is just, you know, in many ways, this is a lot more similar to Apple with the retail consumer side of it and Amazon with the CapEx investor story, you know, invest every dollar of free cash flow into growth side of it. This is an Apple, Amazon-esque strategy play much more than it is any automaker. Is when you look at the cash flow and really unpack this. And so that's why I love this asset and this chart that you showed here is because you're basically replicating the first line of Amazon's press release, which is the adjusted true sort of operating cash flow of the business, which is what, if I'm right, you're trying to show us here. So if almost like, if I'm pitching Martin and Tesla, I'm like, yo, you know, if we're trying to really scheme a la Amazon here and readjust what is the first metric of our quarterly press release, is it this metric right here? Mayur would say, yeah, probably, right?
Yeah, I think so. And but really, let me back up a little bit. The idea of this, though, is just in the short term. I don't actually mean this to be the ultimate number, starting with adjusted EBITDA. The only reason why I'm showing this now is because of, you know, those three factors, right? That I believe is going to be artificially depressing earnings. One is the above average stock-based compensation that's, you know, attributable to Elon's bonus structure. But also because of above average capital spending that we're going to see in the coming years, which increases the depreciation that we're going to see on the income statement coming in as well. So one thing that EBITDA does is it tells you what the operating profit is before the effect of all of the high-end you know, capital investing that the company is doing. So, for example, if you are focused on GAAP earnings, then you're going to, you know, in my view, incorrectly penalize companies that are radically investing in their own business, that are investing for growth, right? So, if for a company that's investing a lot in CapEx, it's going to come up on the income statement as lower income or lower profit because of the fact that they are recognizing higher depreciation expense. So adjusted EBITDA helps adjust for that as well, to understand, you know, what is the growth and profitability, assuming or ignoring the expense that's coming from depreciation of all of that spending. So again, it adjusts for that too. So it kind of presents a smoothed out version of profitability that you can use to compare, you know, one company to another.